Welcome to Think Smart with TMFG, the weekly podcast covering the financial topics that are newsworthy and relevant to everyday Canadians. Hosted by Senior Financial Advisor Mike Connon of the McClellan Financial Group of CI Asante Wealth Management Limited, here is today's episode.
Welcome to Think Smart with TMFG. I'm Mike Connon. This is Carlo Cancino, Senior Financial Advisor with CI Asante Wealth Management Limited. So, Carlo, part one of this Understanding the Disability Tax Credit series, we spend time breaking down what the disability tax credit is. We talked about who may qualify, how CRA looks at eligibility, and why it's more about day-to-day limitations than just the diagnosis itself. But once someone is approved, that's when things really start to change. Because now the question shifts to, what does this actually do financially? So we recommend, if you missed part one, go back to episode 350 and check it out before jumping onto this one.
Well, I think this is why, from my perspective, the second part of this topic, it's so essential because there's still definitely a lot of misunderstanding. But when clients come in, they often think, okay, I got approved. So what? I get a bit of a tax relief? The reality is that approval can start to affect multiple areas at once. Taxes, access to programs, income support, and even decisions that could include your family members. So this part is really about the financial picture after that approval.
Let's start with from the tax side. What actually changes?
Okay, so what changes? You are eligible for the disability tax credit, so you do get a non-refundable tax credit for it. Yeah. And the non-refundable tax credit, if you want to talk about what that is.
Well, non-refundable, remember, you always hear most things are non-refundable, to be honest. Non-refundable means that if you're paying zero in taxes, the government's not going to pay you. Right. So it's not like you're going to get zero taxes, the government's going to write you a check because you have a disability. It can just bring your taxes down to a minimum of $0 paid.
Right.
So that's the non-refundable part. And we talk about transferability of these tax credits, and that's where the non-refundable piece is really important because a lot of people get these tax credits, but they can't use them. So if you have a 12-year-old kid, they get a tax credit, it doesn't do them any good. So obviously, it's not going to help someone, they're not paying any taxes, and you're taking care of that child, so they can pass that tax credit up to the parents. And it's not only with minors. This happens with senior citizens too. So if someone's in a senior home and they have all these different write-offs in there that bring their taxes down to zero, and then they have this non-refundable tax credit, they can go pass it on to people who are doing caretaking for them. And again, make it so their family members that are assisting them can use this tax credit.
Right, and that makes a lot of sense. If you are eligible for the disability tax credit as a minor or somebody without a lot of income, as a family, as a whole, a large family, anybody with the income that provides support could be utilizing it. So that's a good thing to remember.
We're going to find the theory in here is this is really a family thing that has to be discussed in the family. We'll continue to go through that, and that comes up many times.
For sure. Now, Mike, for the disability tax credit, they go up to approximately, I think it's 10,000 in 2026, where it's multiplied by the lowest marginal tax rate.
Which,
exactly.
So you get a 15% rebate of it. It usually comes out for a lot of people around $1,500 they'll get back, essentially, when you do all the math and everything. So it is significant. And what we always tell people, too, is you can carry that back.
Right.
So, $1,500 is like, okay, well, that's not that big of a deal. But if you say, this is from when they first got the disability, well, that's been there for 10 years.
Right.
Well, you can get $15,000 with adjustments on your tax returns just by filling out this form or having your doctor fill it out, send it to the government. And the interesting thing I think we talked about last time is you don't have to do anything.
Right.
Once these forms go in, you don't have to adjust your tax returns, do anything. You just get a check back. They automatically adjust all your tax returns along the way and send you a check for the difference that you're owed.
So if we didn't mention it in the last episode, or if you've forgotten, if you think there's any opportunity, you should be applying for the disability tax credit, going to your doctor and having them help complete that application form with you.
Doctors don't love it. I'll put that warning out there.
For sure.
So sometimes they're going to charge fees to do them. Now the forms have become a little bit more detailed. So sometimes there will be small fees for them to finish that stuff.
What are the other benefits that you receive by having the disability tax credit?
So once you get that, you become eligible for the RDSP, which is a Registered Disability Savings Plan. And this is they can be open, I believe, anyone who's under 60 years old. They're like an RSP in that the growth inside the plan is tax deferred. But the different thing is there's a lot of grants with the money put in. It's income based, so it depends on what amount of income. But the grants can be up to For people that put in $1,500, they can get up to, I think, $4,500 worth of a government assistance put into that plan. And again, it's almost like sort of like RDSPs,
Right.
where the money actually goes in there, and that can create great growth. The other thing to remember too is, as kids are part of a family with a higher income, when they become 18, they become their own family.
Right.
And with that, they can many times qualify for some of these extra bonds and extra grants that go into this account.
Yeah, and you mentioned our ESP, the RDSP, Registered Disability Savings Plan. It's tax-deferred growth.
Yep.
And so as early as possible, if you do qualify, you want to be opening it up and utilizing the time to invest that money, because along with your contributions and the very generous grants that you would receive, it'll grow faster because of that tax-deferred situation.
And also, withdrawals are taxed in the hands of the beneficiary, who's generally at a lower income at the time. So it's a very good long-term savings vehicle.
What about income? And if you're receiving a form of disability income from the governments, what should you be doing at that point?
A lot of times you have to protect that income.
Yeah.
All of a sudden, if someone's on a government assistance for disability, and all of a sudden you start to gift them money, what people don't realize, a lot of times you have them lose all their government assistance. And you think you're doing good, but all of a sudden that monthly plan has come to an end that they're getting from the government. So you're leaving the money, but it's actually having zero effect on anything, because it's essentially eliminated all the help they're getting. So there's something out there called a Henson Trust, which is a setup in a will that makes it so you can leave money for that beneficiary, and it has two impacts. Number one, a lot of times with someone with a disability, you want someone else managing that money, rather than them having it personally. So that's one piece of the Henson Trust. The second piece, if they're set up correctly, the income off that will not affect the disability benefit they're getting from the government. So it keeps that intact, so they can still continue to live in the place they're living, have the same government assistance they're getting at this point, and still have money that's being run for them in case they need it for anything. So that's an important thing. It's more of a complex situation. They don't just say Henson Trust on the outside.
Right, exactly.
If you go through estate documents, there'll be some wording around it that goes and creates this thing called a Henson Trust inside a document. But again, you have to go to a degree in lawyers that use them, because it's more of an advanced strategy than some people are put into their documents.
Ideally, when you're opening up that Henson Trust, it's to take the ownership out of the beneficiary's hands, so it doesn't impact any income you may be eligible for. So it's not owned by the beneficiary any longer. But one of the things with trusts is, if it's invested in earning income, it's taxed at the highest marginal tax bracket. So that can always be tough to deal with. It's a little bit, you don't get that big of a tax benefit. But if you are eligible for the disability tax credit, the trust could be turned into a qualified disability trust, where the tax rates are more graduated, like if you were earning personal income. So that's something that definitely should be explored with your legal professional, so that you are gaining from it, having it outside of your own hands, not impacting other income benefits, and also being taxed less.
I guess when we start to talk about this, it comes back to a family has to do a lot of these. We both have families with people with disabilities in them, and different degrees of disabilities.
Sure.
And what I've noticed is the families really do unite, because there's a lot that has to go into taking care of this benefits. And number one, financial is probably 10% of it. 90% is arranging care to make sure everyone's taken care of. But if we can have them think about the financial aspect of it, it makes everything a little bit easier for everyone. And if we can find ways to make it more efficient, to have them receive money, continue to have their benefits, not lose them. If we can find efficiencies in someone having control over the money, some people have, disabilities that would allow them not to be able to handle money. They would just blow all the money in one day. And you need someone in to control that to make sure that doesn't happen. So that's where it becomes a real family type of situation. How to use the tax credits, where they should be going, how that works, income planning, benefit eligibility to make sure all those benefits stay in place, having saving strategies to have an ongoing saving strategy for these RDSPs, make sure they're using that along the way, and estate flow, how assets are passed down to everyone. So those are all really important things that you have to look at when you're dealing with any type of disability.
Yeah, Mike, the disability tax credit isn't something that an individual should be thinking about. It is more of a family discussion to be had to take advantage of many more things than just that non-refundable tax credit. And I think it was important for us to do this second part of the podcast to dive a little bit deeper into the things that that people would be eligible for.
Yeah, we're not going to solve anything through a podcast, but what we can do is make you aware of what needs to be looked at. And I think that's the main thing is, hopefully we're going to trigger some people out there that listen to this podcast and think, oh, I know someone that might apply to. Let me talk to them and let me see if they put any of this stuff into place. And that's worth it to have someone realize, okay, there's something we can do to help someone that needs it. So that's an important part of why we do this.
Do the application. If there's any thought about it, do the application. The worst they can say is, no, you're not eligible.
Yeah.
But if there is any inkling that you could be eligible, the financial benefits are there. The estate planning benefits are there. We've walked through both parts of this conversation, and hopefully it gives you a clearer understanding of how the disability tax credit fits into a much broader financial picture, and not just as a credit, but as something that can influence how different pieces come together. If you want to learn more about TMFG, you can find all the details in the show notes, including how to connect with us or book a conversation with one of our advisors. We're now 7 advisors deep, Mike?
Yep.
At the office, 21 staff. We are growing, but we are happy to help anybody out there that could use the conversation.
Even just a question.
Exactly. Any questions that came up while you were listening, feel free to leave a comment, review, and we'll happy to address them in a future episode.
Thank you so much. That brings us to the end of another episode of Think Smart with TMFG. Have a great day.
You've been listening to Think Smart with TMFG with Mike Connon of the McClellan Financial Group of CI Asante Wealth Management. Don't forget to subscribe to Podbean, Apple Podcasts, Spotify, or YouTube Music, and leave us a review. For more insights and resources, visit tmfg.ca or follow the link in the episode description. This program was prepared by Michael Connon, Senior Financial Advisor with CI Asante Wealth Management Limited. This is not an official program of CI Asante Wealth Management Limited, and the statements and opinions expressed during this podcast are not necessarily those of CI Asante Wealth Management Limited. CI Asante Wealth Management Limited is a member of the Canadian Investor Protection Fund and the Canadian Investment Regulatory Organization. This show is intended for general information only and may not apply to all listeners or investors. Please obtain professional financial advice by contacting us at 905-771-5200 or visit tmfg.ca to discuss your personal circumstances before acting on any information presented.